Aviation is a very cyclical industry. We've seen it after 9/11, the recession in 2008, and most recently the pandemic. My mission here at the Cashflow on the Fly podcast is to arm pilots with all the tools and knowledge they need to achieve financial freedom through real estate. This is your host, Sach Bernhardt, and I hope you enjoy it. Hey, welcome everyone to another episode of the Cashflow on the Fly podcast. We have Michael Piehler today with us. He is the co-founder and managing partner of North Lone Star Capital, a private equity real estate investment firm that owns and operates apartments across Texas and Minnesota. Michael, welcome to the show.
Hey, thank you. Good to be here. Thanks for having me.
Yeah, glad to have you. I wanted to bring you on because you have an interesting background. You're combining you're a broker, you're a real estate broker as well, right?
Yes.
And I have not had a broker yet on the show that invests in multifamily apartments. So I wanted to get your perspective from the broker side as well. Let's talk a little bit about you before we start talking about the broker stuff. Let's tell us about you. How did you get introduced to real estate investing?
Yeah, thank you. So I got into real estate when I was in college. So I was an economics and finance major in school. Thought I wanted to be a financial advisor. Was really focusing on the finance part of school. Got into like my major classes where we're investing in stocks and stuff, and picking a portfolio for a simulation for a client and stuff like that. And just realized that there's so much that's out of your control when you're investing in stocks. And I just didn't really like the idea that like a CEO could tweet something and the stock could go down 15, 20%, and it was completely out of my control. And even if I did operate and analyze the stock best I could, there's just so many things that I wasn't able to control. So I got into commercial real estate through a friend of mine who is a broker, and kind of realized that first of all is an asset that you can see, it's tangible, and then also learning that you can invest in these things and you have control. That's where my mind shifted, and it's much more simple. It's a necessity. That's why I got into commercial real estate versus continuing going into the financial advising area. But we can touch more about that and get into the specifics later about syndications versus stocks. But yeah, so got into investing in commercial real estate, got a partner who's owns some single family rentals, and he and I partnered up and created what is now North Lone Star Capital. He's sold some of his single families, and we've transitioned into multifamily. While I was in school, I got my real estate license, and as soon as I graduated, became a broker, and I'm under an advisor broker right now. And so he and I also do brokerage. Got my broker hat and as well as my syndicator investor hat.
Dude, I love it, man. Let's talk about it right now. Let's talk about some pros and cons of investing in stocks versus multifamily syndication or just real estate as a whole.
Yeah, and one study I really like there, and there's a lot of data behind this. One study I really was Thomson Reuters between, I believe, it was 1993 and 2013. They looked at all different asset classes, commodities, real estate, stocks, and they basically evaluated on a risk-adjusted return basis. Because when you're investing, you can't just look at the upside, right? You got to look at the downside as well. So they took over that 20-year span, they took a look at all different investment vehicles and determined that so like when you're looking at stocks would be on the higher return side as well as the higher risk side. Bonds were going to have low risk, low returns. And what they found is that commercial real estate as a whole had a similar risk profile as bonds and a similar return profile as stocks. So you basically get the same, if not better, return profile as stocks with the same risk as bonds. And that's commercial real estate as a whole. And so that's including your strip malls, industrial, multifamily. And I think personally, if that was just apartments, specifically B and C class apartments, I believe that would have shown an even more skewed result, being higher risk or less, excuse me, higher return and even less risk. And one is because apartments they're a necessity. It's housing. No matter how many NFTs you own, like you're going to need a place to live. So it's a necessity that everybody needs. And the cost of construction right now for new housing, it's ridiculous. Like the affordable new home, like that's non-existent. And apartments are one of maybe, if not the most cost-effective way to supply housing. So there's a lot of tailwinds behind it. Just looking at a macroeconomic level, it's an essential need. There's not enough of it. It's something that's always going to be there. You could also look at the volatility. So with B and C class properties, they historically have some of the highest occupancy rates, and it's because during downturns, they might be moving from, maybe they get foreclosed on, or they're in a really nice apartment that they can't afford anymore. They'll be moving into those B and C class properties. B class might move to C, etc. During good times, same type of thing. There's people that are moving out of mom and dad's house up into apartments. So historically, B and C class apartments also have just high occupancy, which helps when you're looking from a risk side. There's always going to be a lot of occupancy. And then also, like I touched on briefly before, with multifamily, we have control of the asset. So when circumstances outside of our control are affecting our property, we have levers that we can pull to combat those outside circumstances. Whereas if you're just investing in stocks, there's nothing you can do besides sell it and buy something else. You don't really have control of the operations. So those are some of the big reasons when you're just looking at historical performance of stocks and picking a stock versus just investing in an index fund and riding whatever the market's doing. It's very rare that you're able to pick a stock that outperforms the market. And I would say that kind of goes into investing in a syndication versus having a financial advisor. Our incentives are aligned with our investors. We don't get paid unless we perform well and operate to how we've underwritten the deal. Whereas most financial advisors are getting paid whether or not their portfolio goes up or down. And so that's something that I think is wrong. And then also, it's very hard to beat the market. Paying someone to basically do what you could do by putting in an index fund is, to me, just doesn't seem right. And I think most people are starting to realize that you can invest in these large cash flowing assets, and it's not just for the mega rich and these institutions. With syndications, you can partner alongside people like myself and get a piece of that action, and not just think that it's for someone who's already made it big.
Dude, I love everything that you just said. I think there's a common graph that I see being thrown around in different social media platforms, and it has two graphs in comparing a common, like just an investing in an index fund and investing in real estate. And both show that over the last 10 plus years, there's been a 10% return on the investment, either one. So people say, why do all this real estate stuff if I can just put it on the index fund and not do anything, right? But what I keep, every time I see the graph, I keep putting my comment saying that what the graph is missing is just that it's talking about real estate as a whole. It's not differentiating your investment strategy, whether you're doing a value add project or if you're holding an asset forever. Is it a single family? Is it self storage, apartments? No, it's everything all together. So what's the important piece to differentiate there is what you just talked about, which is investing in multifamily apartment complexes. And I'm assuming we haven't talked about it yet, but your strategy may be a value add, right? So
Yes. Yep.
every
No.
3 to 5 years, we're turning a property around,
Right.
and we far exceed 10%, like no questions
Right.
asked.
And one thing too, I'll just jump in real quick, that the study I touched on doesn't account for, and probably the graph you're looking at doesn't account for, is the tax advantages of owning real estate. So if you add that into the pie, you're going to be paying your 20% or whatever your capital gains tax with stocks, long-term capital gains or short-term. Whereas multifamily, there's a lot, or syndications in real estate, there's a lot of tax advantages that you can mitigate most of your tax liability. And most of those studies don't even factor that in, which for some people, that's the only reason they invest in real estate. And that's just something that just adds to the returns there on those graphs. But yeah, like 10% would be a pretty bad deal for us if that was our annualized rate of return when it was all said and done. And yeah, when I see that too, I'm like, man, if people are happy with 10% in stocks, just wait till you just try like syndications. I've talked to quite a few investors who have done that, and they're like, man, I don't know why didn't I do this? And I think it is because people just don't realize that they can access it.
Yep, I think it's a big deal. I think a lot of people think that the apartment complexes are owned by one particular person that is super rich and not via syndications. And tell me, just so you knew you didn't want to do stocks, so then you gravitated towards real estate. What specifically got you interested in apartment syndications or multifamily, other than starting in single family homes?
Yeah, no, great question. Because I thought I was going to be a broker on the industrial side of commercial real estate. I thought I wanted to be an industrial broker and liked the kind of the tailwinds that industrial properties were having with everything going remote and you need all these distribution centers. I went to, I think like most people, I started reading like all the good real estate books, listened to Bigger Pockets as well. Went to the local real estate investing meetup, which most people there are not investing in industrial properties there. It's all single family or multifamily. I got introduced to it through my brokerage and had some access to some people there who I could ask questions on. And then I went to a real estate investing conference here that was put on locally. That was Tyler Devereaux and his group. They put it on here, and that's where I met my now business partner who was there to learn how to go from single family to multifamily because he had single family and wanted to get into multifamily. And he and I just values aligned where he's owned multiple businesses and has the ability to do this, but doesn't have the time. I didn't have the ability to do it at that point, but had a lot of the time. And so he and I just, it was a perfect partnership, and just was really attracted to single family, or excuse me, multifamily, because of the reasons I kind of outlined before, especially the necessity part. Like it is like everybody needs housing. And so that was a big driver to me to go into multifamily.
I love it. What is your particular skill set in apartment syndications, and how did you develop that skill set?
Yeah. So a big one is sourcing the deals. So through broker relations, as well as up here locally, cold calling and talking to owners. And that's nice because you can wear two hats there. And if someone isn't looking to sell directly to you, you could always offer a listing proposal and potentially list it for them through the brokerage side of things. So definitely deal sourcing is a big one, as well as underwriting, and then raising money through investor relations and talking with potential investors and partners and stuff like that. So it's really, yeah, deal sourcing, underwriting, and then investor relations. My partner, his specialty is the asset management side. He actually owns a property management company and a remodeling company. So that's his expertise.
So you guys are essentially vertically integrated because you're finding the deals, you can bring capital, he can manage the deal and do the construction.
Yes, exactly. And so right now we've partnered with other operators just because we're young and we don't want young isn't in the sense of I'm young by age, but young as a company because my partner is not young. So we've partnered with a couple other operators so far to get that experience and be able to lean on them from their past experience and knowledge in the space. So we are partnering with other operators, but are set up to eventually have everything in house. The deal we're working on right now, we're partnering with one other group. The previous deal we had, there are like 4 or 5 other groups. So we're getting to where eventually I think we'll be able to do everything in house, which there's huge advantages for that. Just more control. And then you're able to make, obviously, when there's less operators, you're going to be able to own a bigger piece of the pie, as well as just more control. And so that's, I think, the end goal. But for the next year or two, we'll continue to partner up and be able to scale faster that way.
What's your main source for finding deals when you're doing direct to seller or direct to owner?
That's hard because, like, obviously a co-star list and you've got your list of owners and you're just making calls. That's really hard because if I'm able to access their phone numbers that easily, so is 100 other people, maybe 1,000. And so honestly, that is, your conversion rate is going to be very low, but it still happens. So I still make those calls, but trying to honestly going to like local meetups and trying to find these local owners and operators who might own themselves or know someone who owns a property that we might be interested in. I think that's one of the best ways, as well as through LinkedIn, because then a if you can find an owner who hasn't been talked to by 100 other brokers and 1,000 other investor operators, that's where you're going to actually have a better conversion rate. So it actually takes a lot more time and it's harder too. But yeah, trying to really dig deep and find some people who haven't been touched by a bunch of other people. So yeah, through LinkedIn, digging and trying to find who the owner is, and then just reaching out. And then there's also a face to the name that way. You can just say, hey, we're looking to invest in this area. Would love to have a conversation, see if you guys are ever interested in selling, because we're buying right now. And so it's hard. If it was easy, I think a lot more people would be in this space and be much more successful. But that is 100%. I think that's one of the hardest parts of this industry. It's finding those good deals that nobody else is looking at.
Yeah, absolutely. It's a great advantage for passive investors. If they knew how much work it requires to just put a deal together, and just because there is one thing getting a deal to the finish line and then executing on the deal, and both things are pretty hard. So if they knew everything that goes along, I think they're pretty happy already with the returns that they're getting. But if they just knew how much work it takes, they will be even happier to know, wow, this is how much it takes and I don't have to do anything at all.
Yes, for sure. Like our first deal, it took, I don't know, 6 to 8 months, something like that. And we probably looked at 100 plus deals, got really deep into it on 30 to 40 deals submitted. Like we're probably close to 15, 20 LOIs, and best and final on quite a few. And it's just because, we have these return metrics that we need to hit, and we're not going to sacrifice our underwriting because we want to close on a deal. Like we're going to stick to what returns we need to meet conservatively, just because we don't have a crystal ball. We don't know exactly interest rates might be at in 2, 3, 5 years. And so we're going to underwrite conservatively, and we're not going to give up some of those assumptions just because we want to get a deal done. And so I think, talking with investors and letting them know when you're presenting a deal, and I think it comes off in like our excitement when we're presenting a deal, because it's like, you guys do not realize the work that's been put in on the back end to be able to present you with this opportunity. Like and that's always funny, because to us, it's always such a no brainer. And it's, yes, like this is an unbelievable deal, and obviously they're going to push back on some assumptions and questions, but it's so nice to be able to assure them, because of your experience, and basically like you've underwritten 50 other deals, like that this one is good. If you're a limited partner, if you're looking to invest, it's definitely working with operators who stick to basically their rules or whatever, and not flexing those just because they want to get a deal done. Like they basically are sticking to what their underwriting assumptions are, is very key.
Yeah, I agree. What are some of the challenges that you've faced throughout your syndication career so far?
Getting deals. So
Getting
being
deals.
told, being told no, being best and final on a few deals, and then having someone come in late and increase their price, and basically being told, hey, just increase it X amount and it's yours, and not being able to for the good of our investors. That's always tough, because you've put in months of work into a deal and having it fall through. We've had 2 other deals that we've been under contract that have fallen through for reasons like they were the seller's reasons, nothing that we could control. And just, like you put in 2 months of work, having it fall through when you're somewhat close to the finish line is very tough, but it's also a great learning experience, and it makes the successes feel so much better, because you realize it's a very hard industry. Like it's not super easy. I understand why a lot of people aren't in it, because you do have to you have to always have something else working. You can't just focus on one deal at the same time, just because, what if it falls through? You always have to have multiple deals that have potential that you're working on. It's definitely something that I've gotten to understand, that like I guess, eat what you kill. And if you're not hunting, then there's no food. So you always have to be working. And it's definitely a mentality that I think most people in this space are cut from the same cloth and understand that. And that's a awesome advantage of being a limited partner. You don't have to be that person. You can still benefit from what we're providing, but you don't have to be the ones that are doing the day-to-day work like we are.
Yeah, absolutely. You invest in Texas and Minnesota, right?
Yes. Yeah.
Why did you
So
choose those markets?
I'm originally from Dallas, and then moved up to the Twin Cities to go to school. One of my co-founder, my other partner, is from Venezuela, and then moved up to Minnesota, I believe in his late 30s is when he moved up here. So he and this is our backyard. And so we want to be an expert in our backyard. And then also there's 3 partners. Our other partners out of Dallas, Fort Worth. So we're able to invest in areas that we have local knowledge, and that real estate is location specific. I'm sure most listeners would understand like there's a huge difference from one street to 3 blocks away. There could be a huge difference in owning a property that's within a mile radius, and that's something you don't understand unless you're in that specific market. So being able to understand like what the good locations are, as well as being able to drive and see a property within a day, I think is our goal. So right now it's just the Twin Cities, suburbs, and Dallas Fort Worth is our target market, but eventually we're looking in the greater Midwest, Kansas City. That's a 7-hour drive for us. So we'd be able to get down there within the same day. So I think it's making sure we're not overreaching and stretching ourselves at this point. We want to be knowledgeable in the markets we're investing in and have the ability to basically see the property the same day if we needed to.
Yeah. You have a deal that you guys are working on right now, and that should be closing soon. Can you tell us the specifics about that deal? How do you the market, the numbers?
Yeah. So it's in Rochester, Minnesota, which is like an hour and a half south of Minneapolis, and it's a great little market. It's definitely a tertiary market, but there's Mayo Clinic hospitals right there. So that's a huge economic driver as far as wage growth and stability. There's a lot of people that are employed there. It's not going to the median income in the area is around $100,000, which is pretty high for most tertiary markets, and it's because of the hospital that's right there. And that's something that when we're looking to invest, we definitely want to be in stable and growing markets. And Rochester checks those boxes. The property we're looking at is it's a 78 unit property down there. It's your basic value add play. It's a 1978 build, but it's in a great little area. The property is right next door are achieving rents $300 to $500 above what our current property is at. And our property is newer vintage, the subject or the comparable properties that I was mentioning. The reason why this property is such a good deal is because the current operators are out-of-state owners who are just never there, and they're not operating the property as well as it could be. So we would be coming in and really renovating the units, putting in nice amenities. There are no amenities on the property. There's no in-unit washer and dryers. We'll be putting in-unit washer and dryers, just your basic value add play in a property that sadly like being run down because of the poor management, and they're just capitalizing on the fact that there's not enough housing in the area and are still able to rent this thing out. So in a normal market, or if there was enough housing, this thing would probably not be operating well at all. But because there's not enough housing right now, they're still able to occupy it. So we'll be coming in and giving the residents a nicer living conditions, as well as adding certain amenities to attract some new residents who are looking for a nice place to live. So it's a pretty cool deal that we're excited to be able to present to our investors, and we're looking for a 5 to 7 year hold. So it's actually a longer hold than most syndications, and that's because it cash flows really well. The preferred returns are probably going to be 8%, and then that's a floor. So there's going to be some on top of that year over year.
I love it. You hardly see any very cash flowing apartment complexes deal. So that should be pretty good for investors that are looking for the cash flow. Awesome. Dude, Michael, this has been an awesome podcast. We're reaching the end here. What advice would you give to listeners to help them grow their business or to learn more about investing passively in real estate?
The biggest advice I was given getting into this business, and I still give to everyone, is just reach out and make connections. It's a business where you need partners. You can't do everything yourself. And most people in this space are happy to have conversations, are happy to give some advice. So if you see someone who's doing what you want to do, like literally send them a message on LinkedIn or email them. Most people in this space are happy to have those conversations when you're as far as getting into the space, as well as if you're trying to look for a deal. The worst they can say is no, which that's not a bad thing. That means, okay, they're not the right person and you move on. So I definitely say not being afraid to reach out and just have those conversations and just keep knocking on doors, because you never know which will open. And that's something I'm super grateful and fortunate of. I did not think I'd be at this point this early in my career. And it's solely to the fact that I knocked on doors and reached out and talked to people when I was scared to. I'm naturally not an extrovert, but I forced myself to do it. And because of that, a lot of doors were open that I thought would never be able to at this point. And that's just like a life in general advice, like just knock on doors that you don't think could be open, because you never know which ones will. So definitely that applies to real estate as well.
Yeah, I love that. How can listeners connect with you and learn more about what you're doing?
Yeah, you can check out our website, northlonestar.com. On there, you can subscribe to our investor list. From there, once you're on our investor list, you can book a call with me. One, I'm happy to get to know you a little bit more, see if investing with us is right for you. It's not right for everybody, but I'm happy to have those conversations.
Cool. I love it. We're gonna put that a link on the show notes. And Michael, it was awesome having you in the podcast. We'll look forward to having you again pretty soon.
Thank you. Appreciate it.
If you want to never miss another one of your kids' practice games, spend more time with your family, or simply do more of what you really like to do aside from flying, grab my book where I explain in detail everything you need to know to make this a reality. Go to bernhardcapital.net/ebook and download my book. It's completely free, and I hope you like it.